The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Hello and welcome to this Become a Pro course presented to you here by Forex.Academy. Today, with this particular webinar, we'll be going to discuss market correlation. Okay, so we're going to look across many different asset classes, discussing their statistical inference and really get into depth with market correlation. Now, before we do so, please consult the following disclaimer. There is, of course, risk involved trading the financial markets. And just as always, a few pieces of housekeeping before we begin. Of course, feel free to ask questions throughout. It is a fully interactive live webinar, so make use of the question and answer portal. Of course, you can locate the chat box there on the right hand side of the screen. So at any time you can consult with me there. I'll be able to correspond with you, see your questions, and hopefully answer them on screen here. So make use of that, of course. This live webinar is, of course, being recorded and will be available in your members login area roughly around one hour after today's live lesson. And we will, of course, be hosting an extended Q&A session at the end of this live webinar to deal with some of the topics more constructive on, of course, market correlation. We'll be getting quite in depth with it. So if you'd like to save some of your questions to the end, we can certainly go through them there. So this brings us to the end of, well, the final week, of course, to the Become a Pro course. With the course overview, we're now starting with week 4. So we'll be discussing today market correlation, highlighting market correlations between asset classes, various markets according to risk perception. Okay, so trading these financial markets, guys, you may have heard me reiterate this quite a few times. It's all about trading risk. You know, so many of these different assets have a risk premium to them. That is why, of course, it is riskier trading equity indices as opposed to perhaps trading bonds or trading very volatile commodities, perhaps. So that will lead us on then nicely. This week we'll discuss risk in its full capacity with risk aversion as well, leading into portfolio diversification. So effectively learning how to not only mitigate risk or manage risk on each particular trade, but looking to how to spread risk across asset classes. So that's known as portfolio diversification. How to develop short, medium, long-term positions as well, as a sort of ramification around trading your own style of portfolio. And then we'll be delving into really developing a profitable trading strategy. Now that is going to be a fantastic lesson indeed. We're going to combine all of the fundamental and technical analysis we've learned through the Become a Pro course so far. And really that's going to set you on the path to entering these markets with your own framework for risk and your own framework for strategical trading. Okay, so that'll be a very, very interesting topic indeed. So let us move forward with today's particular lesson. Again, we'll first define correlation itself. Correlation now is a statistical measure that determines how assets move in relation to one another. It can be used for any financial security, but it is often aimed at markets within the same asset class. Now, it's often aimed at the markets within those same asset class because that will be how you'll be looking to effectively trade some of these markets. We always look for markets, you know, for indications of strength or weakness across asset class to give us an idea whether the markets are strong. When I say the markets, more particularly, we focus on perhaps equity trading. So you look across the different equity markets to think, well, okay, there's been a bit of a lift today. We're moving on with a bit of bullish activity in the equity markets. Perhaps there's some good news flow across Europe and the US, and that will give you an idea to look to trade different assets within that sector, of course. So you might see, for example, one market outperforming during the course of the day. So if you're looking to trade perhaps the US equities above and beyond the European equities, if they are stronger during the course of that day, well, if you're looking to take a long position, you're more likely to have a successful trade in a market or a series of markets that are performing stronger or outperforming during the course of that trading period. In terms of correlation itself now, we'll get into a little mathematics throughout the course here. It is expressed as either a percentage or as a relation to 1. Okay, a perfect positive correlation between two assets has a reading of +1, whilst a perfect negative correlation has a reading of -1. Correlations will be expressed more often as a decimal, for example 0.684. So that is just more common practice in terms of mathematics and financial trading. In terms of sample distribution as well, we define it as a fraction of 1, of course, as opposed to a percentage. It's fine to say, of course, that there's a very strong correlation between gold and silver. They are, 87% correlated, but we'll use statistical reference, of course, as 0.87 there. During times of instability, many international stock markets become highly correlated as investors analyze the risk of similar securities in their portfolio of assets. Now that will be something we'll touch on a little. Again, we'll discuss it in a lot of detail tomorrow, just in terms of the current risk theme. What is the current risk theme? Usually it's simply defined in two methods. It's either risk on or risk off. Risk on being an appetite, a general appetite across global markets for investors, for traders to indulge in profit opportunities across riskier asset classes, equity markets, equity indices, perhaps volatile forex pairs, depending where the volatility is, of course. Then, whereas, of course, if there is a serious unsettlement or uncertainty, perhaps we can say, the relative equity sell-off there, the US equity market correction, which was generally a correction around 8%, a lot of uncertainty entering the markets at that time. Perhaps we can discuss, the Brexit decision. We can discuss the French election there about a year ago. We could discuss, of course, the US election, November, a year and a bit ago. These are high interest economic events where there'll be a serious amount of uncertainty and economic activity fluctuating around those levels of uncertainty that will deliver traders and investors alike a certain sentiment to suggest, well, let's look for safer short-term opportunities to see how the landscape plays out over the short term. Okay. Why does correlation matter? Why is it so significant for traders to understand that markets are correlated, but to actually look to trade that correlation? Well, it helps investors to choose the amount of diversification in their portfolio. Now, that's just another way of saying, guys, risk. We're looking to choose the amount of risk, but there are several ways you can look to mitigate risk. One, of course, being the fact that you can, place a stop loss as the market moves with you. You can move that stop loss above and beyond your entry point and obviously mitigate away that risk. But you can actually look to naturally mitigate or delete risk across different asset classes intrinsically by not trading similar asset classes. Of course, you're looking to spread natural inherent risk across different markets. So it helps investors and traders alike to diversify their trading. It provides insight into an overall perspective of economic performance. And again, if you're trading an idea, if you're trading a long euro idea across different currency pairs, well, you'll need to know the economic performance of the Eurozone. One way to judge and look at that will be, of course, to look at the equity markets in Europe. You're looking at economic performance. You're looking for guidance. Is the DAX strong in the day's trading? Is the CAC 40 in France there, is it strong? Is the UK FTSE 100 strong? Many markets across the Eurozone as well will give you that perspective on overall economic performance. And correlation can increase during periods of volatility as well. And we've just mentioned that there in times of uncertainty, you do see risk-averse assets see a lot of correlation. It helps traders to manage risk by choosing assets with low correlation as well. So that's very, very interesting to point out. Again, not everything has a really strong level of correlation. You're not only looking to mitigate risk, but you're looking for other opportunities. So let's say you have 3 very good opportunities and you've capitalized on them. However, they have all some link to the US dollar perhaps. So let's say you're in a US equity market, you're trading gold and you're trading the US dollar. Obviously, you'll have a certain level of correlation with gold and the US dollar, which we'll talk about during the lesson. And the US equity market is, of course, priced in dollars and will move in accordance with large appreciations or depreciations in the dollar market. So you have a few hedge trades on there, but you're aware now that you can look across a different asset that has a completely different, absolutely no relationship, or perhaps a low correlation to those asset classes. You can look for opportunities there as well. It can prevent traders from taking too much associated risk and thus poor trade decisions. Okay, and that is very, very unique for us all as Forex traders as well, guys. Not only as equities and bond and commodity traders, there is so much risk inherent in trading Forex pairs because, well, guys, the bulk of the Forex market is made up with around 8 majors, and we can move across the minors as well, but the bulk of the volume and trading transaction is made up of 8 major pairs. Now, if you're looking to have 30 open trades in Forex pairs, you're going to have a level of confliction there. You're going to have many trades that are going to necessarily overdo each other, and that is poor trading. So I'd like to really paint this picture out for you in this next slide. Why does correlation matter? Okay, well, all of these Forex pairs are correlated. So can we see that just to the left there? Actually, all of these Forex pairs are correlated in some way or another. Now, I've kind of tricked you there just because we see the quote currency on one side and reflectively we see the base currency on the other side for lower pairs there. So effectively, these are all correlated to the US dollar. If you're looking to take, we have 9 markets here in front, 9 Forex markets. If you're perhaps looking to trade all of these pairs, well, there would be absolutely no point to trade all of these pairs at the same time because when there's going to be a strong move in the US dollar, you're going to, of course, have a totally conflicting idea of how these markets are moving. Unless, of course, you are short the front 4 Forex pairs and long the 5 lower pairs there. Of course, you're going to actually be simply long all of those markets. So along all of those dollar trades, but obviously that's incorporating a large level of risk to your trading. So you can see where I'm getting at here, guys. Simply, and I'm just looking at the Forex markets here, not even other asset classes. These pairs here, where the US dollar is quoted as the quote currency, will trade in the same direction in relation to the dollar, whereas the pairs below the base currency will trade in the same direction in relation to the dollar. So if you're actually long and short both, well, you're effectively hedging your trades, and that would be quite silly unless there is some real sentiment or a good idea behind the trade. So let's first of all discuss positive correlation. Ideally, we are aiming to observe positive correlations across different markets so as to assess and mitigate possible risks in assuming positions. If we have 2 markets that share a correlation of 0.92, then we can assume that they will move in the same direction, specifically over the long term. Okay, and you'll see as we go through some correlation studies here, guys, that is certainly the case. Those that have very, very strong correlations, perhaps above the 90% or 0.9% percentile, of course, will be very, very correlated, very strongly correlated indeed. So they'll look to move in the same direction. Now, of course, if you zoom in on those candlesticks to shorter time frames, they will often move, and because of volatility, you might get, Facebook and the Nasdaq having some bad news out. Well, that won't affect the Dow Jones, and you'll see an adverse correlation within the short term. Over the long term, however, that is, of course, not the case. They will look to follow the same direction. So there is trading opportunity there. You can see what I'm getting at already. If for whatever reason a market is lagging and is experiencing some daily weakness during a trading period, where its closely correlated markets are strong and outperforming, we may define that as a statistical buying opportunity. We have more statistical confidence in this type of trade where the correlation of market 1 and market 2 is 0.92 as opposed to 0.76. Now, can we see that, guys? The closer to 1 in terms of defining positive correlations, the stronger the positive correlation. So we're going to have much more statistical confidence in a market that's correlated and has a statistical positive correlation of perhaps 1 plus 1 to perhaps something that is quite correlated to another market but has perhaps a statistical correlation of 0.6. Okay, so we don't have the same levels of confidence in that trade. So here we have some positive correlations to go through, and again describing two or more markets where their prices move closely in relation to one another. Now what we have here is the gold and silver market on screen. Well, first of all, we have only the price action in the gold market, and I've actually chosen to use a line graph just to show you a long, complex movement of price action from left to right here over a very long period of time. Now, would it surprise you that this is exactly what the silver market looks like on top of this? Now, of course, we have a totally different price for silver than we do have gold, so it doesn't relay in tandem to exact pricing. What is significant, guys, here is the movement of price, and that is physical correlation that we're able to see in this market, these markets. So just look at the move down to the downside. We're here right from the left. We see a bit of a sharp decline. Again, you might see more volatility, perhaps in silver for whatever reason. You may see more volatility in gold on a particular trading day or week for whatever reason. So what you're looking to see then is, of course, those lagging factors, or perhaps those leading factors to look for a trade. Let me give you a very simple example. During the course overnight, during the Asian session, perhaps gold spikes, perhaps $20, and is still in and around the lows. So let's say it spiked down $20, and you come onto the trading platform at 8 o'clock for the cash open, and it's still down $15 while silver hasn't moved from its open price from the day before. What you may look to do is obviously sell silver. Of course, we'll talk about other trading strategies within this webinar, but that is a very vivid picture I'm painting there in terms of looking for these correlations. You can see as we have very strong moves, we have similar moves in the gold market as well. Okay, so we're effectively looking to trade this somehow or another, and we can see each and every time we see significant moves in the market, well, that correlation is very, very tight, very extreme, and is very strongly correlated to one another, these particular markets. Again, as we see a little bit of a movement as well, we see the silver market start to trade to the downside, and obviously this gets a lot of volatility just here with recent price action as well, the inflation trade taken over there not so long ago. But you can see obviously when I delete some of this, I'll delete some of this annotation there, you can see how closely the volatility or the movement of price is swaying these markets to one extent or another. And of course we can see the extent of these moves, guys. These markets are very strongly correlated, but they are not 100%, i.e. they're not at a correlation or a positive correlation of 0.1. So there is that level of discrepancy there. So always be aware of the risks involved, and that's getting this education. You can create trading ideas, but always be aware in the inherent risks. So let's move on then to discuss negative correlation. Quite the opposite, guys. Negative correlation suggests that two asset classes or markets will move in an opposite direction to one another. A perfect negative correlation implies a statistical relationship of -1. Equity markets and bond markets traditionally share a negative correlation whereby if equities had a strong bullish day, the bonds would have a weak, softer trading day, and vice versa. Okay, so that more often used to be the case for the past 30, 40, 50 years. We've seen you may go to your trading screen over the week and the equities are quite strong. And that, just think of the risk premium there where equities are slightly riskier to trade but deliver that higher level of return. Well, if they're returning well, more traders are going to trade them, more investors are going to increase their capital flow into those markets, pulling money out of other markets such as bonds. So you'll very often see a bullish candle for the equity markets, let's say the S&P 500 and the US 10-year Treasury bond show an inverse relationship, or in this case, a bearish candle. Now, I wanted to mention this, but this traditional relationship has started to unwind, really as a result of recent monetary policy. The correlation has recently outgrown to some extent this traditional relationship given the economic significance of bond purchase programs, i.e. QE or quantitative easing. Now, why might that be the case? Well, simply because the monetary policy with QE suggested that we're not only going to prop up the bond markets by buying a lot of bonds, let's say the Federal Reserve, or in Europe the central bank here, the European Central Bank. They try to stimulate growth by allowing bond purchase programs. So basically buying a lot of treasuries from the bank itself, so creating those treasuries and looking to swap bad debt for good debt. So buying bonds, of course, creates demand for bonds, and you're going to see the prices of those bonds increase as demand increases. However, one of the stimulus packages as well focused on actually asset-backed securities, or looking to, look at the financial sector as well and trying to swap corporate debt, poor corporate debt, with good debt. So that would effectively create a much more stable financial system, and obviously the banking systems, a lot of these large banks and equity markets were also stimulated and bolstered by QE. So it effectively looked to create demand across both asset classes. Traditional relationships started to erode over the past, I would say, 6 to 8 years there. So do be aware of it, and as these interest rate increases start to move and advance across the globe over the next 2 or 3 years, we'll likely see this traditional relationship start to come back across with a negative correlation in the equity markets and bond markets globally. And as a real sticking point here, gold and the US dollar share perhaps one of the most notable negative correlations. Okay, if you didn't know that, so gold is priced in US dollars, obviously, and shares a very, very strong negative correlation with the dollar itself. So just think about that logically. If let's say a golden bar is priced at 200,000 US dollars. Let's say there's a strong move to the downside in the dollar, so the dollar starts to depreciate. Okay, well, if the dollar depreciates, let's say by 10%, well, effectively, what is the value of that gold bar? Hypothetically, given that you're going to need an amount of dollar to chase that gold bar, to purchase that gold bar, it's going to be 220,000, because it'll move as a result in terms of being priced in US dollars, reflective as a precious metal and holding its store of value as such. So we can look at that on screen then. Now we have a negative correlation again, describing two or more markets where their prices move in opposite directions to one another. So again, we have gold here, the same chart that I had up previously, gold and the US dollar. So you can see, of course, it doesn't have, of course, a -1 negative correlation. It has quite a strong long-term negative correlation again. You would need to do, of course, your correlation study to look at short-term factors in such. I believe short-term, you probably would get something around the correlation of around 65, and over the long term, much more heightened. But do factor in that you'll likely see this day on day. When you see a very strong move in the gold market, it's often as a result of a very strong move, the opposite move in the US dollar market, and vice versa. Okay, so do factor that into your negative correlation trading. Asset correlation now. Okay, assets that share the same risk association inevitably share a level of correlation. Okay, so again, we discussed equity markets. If they're all, let's say, performing at 6, 7, 8% per year for those equity indices, that is a higher return to invest in equity indices than bonds, of course. So they're going to have the same risk association for traders and investors over the same amount of period as perhaps those return on investment bond markets or any other markets that are sharing the same risk association. When investors seek more risk, their capital will move into the equity markets for higher yielding opportunities. When they seek risk aversion, so in times of economic uncertainty, they will seek risk aversion. They will choose to move money out of the equity markets and into safer investments such as cash instruments and bond treasury markets. It is this interaction with the current market sentiment that defines the market risk theme to be either risk on or risk off. Okay, so risk on is, it's happy days for the traders and investors. They see a welcomed level of risk. They look for riskier assets to trade, given that the sentiment is good, perhaps the economic environment is stable. We're looking to see economic growth continue, and there should be a qualitative level of return from that risk. Risk off, you're going to see a level of strong risk aversion where we look for cash instruments, perhaps ETFs, perhaps bond markets, safer markets where we can hold or store wealth until times settle, and we can look for economic stability to bring back that risk on sentiment. So this is ongoing in the markets, guys. This risk on, risk off theme is an ongoing cycle within the financial markets. Traditionally, given markets are attached to individual levels of risk, treasury and bond markets are said to be lower risk investments and are so correlated. Moreover, bond instruments which have the same duration and country risk premia will share a high level of correlation. Investing in equity markets are higher risk opportunities, and so equities and equity indices will share a strong level of correlation. Okay, so I'm just reiterating there, guys. Furthermore, those equities or indices will with the same nature or in the same region are regarded as highly correlated. Okay, so what I mean by the same nature, let me choose some markets there. Of course, we have, we can use the German 120. Of course, it's heavily invested in the tech sector, and of course the Nasdaq 100 is heavily invested in the tech sector as well. So they have the same nature, of course, as tech index instruments. Whereas, of course, if you're looking to trade sectors, you're going to look at different regions which share the same level of output per sector, perhaps Australia and Canada, given the makeup of their equity indices. It's really two things. It's really the commodity markets, i.e. oil companies, and the banking sector makes a large portion of those markets. Okay, so they're going to share the same level of correlation to a certain extent. Let's look at the bond markets first of all. So here we have, there are two very, very similar bond markets. Now, why do I say that? Well, three things. They offer investors safer long-term investment backed by government. Again, if you're investing in a bond, you're regarding it as a not a risk-free investment, but quite a riskless investment, given that the government is very, very likely to be a debtor to you and pay the full principal and interest back on the bond. So there's a certain level of risk that you're willing to take, of course, and is one reason why they're regarded as very safe investments. They share the same risk premium. What I mean by that, which we'll see during the next slide, I think, basically we have the German 10-year bond, okay, a very safe, stable economy. We have the US 10-year treasury bond, again, a very safe, stable economy witnessing economic performance, as opposed to something like Italy, Ireland, or Greece now that they're still coming out of those recessionary periods. They have to offer more attractive rates on their bond markets and aren't actually able to follow the same risk premium as the US and the German 10-year bond. And of course, the final point is, well, their duration, guys. They're both 10-year bonds. You're looking to invest your money for a period of 10 years in both nations. There is a time value of money there where you need to understand that your money is locked away for 10 years, and that is a risk in itself, as opposed to 5-year dated bonds or 2-year dated bonds as well would be less risky investments because, well, evidently your principal and all your interest is going to be paid after 2 or 5 years respectively. So duration is very important in pricing the bond. Now, as I said here, as we look across the European bond markets here, and I chose a sample there because this is the European sovereign debt crisis there with long-term interest rate on bond prices. Okay, so this is effectively what we've seen. Now, what I would just like to point out on screen, I'm going to use just a simple black pen to analyze this. If we just forget the outliers for a moment, what does this represent, guys? Within our black lines here, what does that look like to me? You can see comments coming in already. Yeah, perfect. One word I'm looking for, really the point of this webinar is correlation, guys. That presents correlation to me. Okay, so we're in between sort of 2.5 and perhaps 6% here interest rate on the bond. So trying to deliver a level of attraction, let's say 3% there for these bonds. Okay, so you can see the level of risk premium, whereas of course as we go up here, above and beyond here will be, of course, given the economic performance in Eurozone and globally, we have around 8% and up will be the equity markets. Okay, so they're delivering that return at the moment. Of course, the US really outperforming last year, but you can see the level of risk premia there in terms of just understanding risk on, risk off, and how markets share a level of correlation to risk premia. So again, just within our bands here, we have a very well structured level of correlation with these particular markets. Okay. Now, as we go up, we can tick off a few here because we know, like I suggested, of course, Ireland was an outlier. It took quite some time to recover from the financial crisis, and as a result, the European sovereign debt problem really grew for Ireland. That meant that we had a spike in interest rates because we were only able to offer very attractive interest rates on our bond market at that time for our debt markets. Okay, so that's reflected in our interest rate for the debt markets. There we have Portugal as well, really showing a high level of interest rate in terms of pricing their bond markets as well. And that means there's a heightened level of risk to these two options. Okay, it's not as simple as saying, well, why would I invest in a bond that involves 5%? Let's say we're investing in 10-year bonds here. Well, 5% over 10 years, that's still good, but if I can get one for 12.5%, why wouldn't I do that? It's much more attractive. Well, of course it is much more attractive, but there's a heightened level of risk. That's the risk or the return on investment there, pricing in your level of risk for your financial security. Okay. That is effectively how the market prices in these bond markets, and that's how we look to trade them. Now, we don't trade the yield, or we don't trade specifically the interest rate on the bond. We trade the price, and we'll get into more detail throughout the next few lessons, more particularly in terms of bond structure, how we simply trade the price of a bond in terms of its yield. A simple inverse correlation, but now we can see, of course, the level of correlation simply by looking at nominal levels here around 5% for European bond markets, in contradiction, or in contrast, I should say, to Portugal, Ireland, Greece at this time was at a peak, delivering or offering 35%, which is phenomenal if you can think about a 10-year bond market in terms of duration and interest rate. So that just shows us how things can break down, how correlations can break down as well, given the markets really find some risk or have a risk theme in terms of certain sectors or nations.